Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Is the price of oil adding to sort of a stagflationary impulse that rests in markets right now? How are the price swings of WTI, Brent crude, leaching through to influence the economy's kind of medium-term direction? And if oil prices zigzag higher on geopolitical news, can markets beat back the oil-induced recessions of yesteryear and have us perhaps land somewhere more like in stagflation-land? Which sectors ultimately of the equity market can power through regardless? Well, joining us here today to discuss departure points across the planes of economic history and how you being better aware of them can help you in decision-making for your clients. This is Fidelity Director of Quantitative Market Research and Strategy, Denise Chisholm. Welcome, Denise. Great to see you.
It's great to be back, Pamela.
We're so glad to have you here joining us. Denise, we would love to ask you so many different things about the oil price. It actually seems to have kind of petered out a little bit. It was a big story at the beginning of the week, sort of amazing what a week can have in it. Do we still need to, think about it too hard?
Yeah, I think you need to think about the historical context that we just went through. And as much as it's sort of yesterday's news, I think it's important to understand exactly what happened and what meaning that has on markets. Even whatever Friday that was, I think it was 2 Fridays ago, or it wasn't last Friday, but 2 Fridays ago, we had a 7% move in a day. Yeah. And the interesting part about that is a lot of portfolio managers came to me and said, well, you always talk to me about a ball in motion staying in motion. Does it seem like there's some momentum here where you could just look at the price action and say, does this predict higher oil prices in the future? And interestingly enough, it does not. In fact, it produces the opposite result that you would think about, specifically as it relates to equity markets. So if you take the 3 months, 6 months, 9 months, and 12 months following that one-day move, what you find is that equity markets return double the historic averages or the baseline, meaning that these aren't always bad things, even though that we think about them as a shock. And that's true in the context of war or geopolitical crisis events that we've talked about before on the webcast. As much as you think it's a definitive shift in global power, it changes the way we think about the globe, it may, but it doesn't always mean anything to equities. If you look at all the geopolitical events going back through history, and you can see this even in World War II, it's not a clear signal on what you should do as it relates to the equity market. More often than not, as much as it could be a defining event globally, it is not the signal that moves the equity market. More often than not, it's not a systematic driver of earnings growth that is the long-term driver of the equity market. I think it's really important that investors consider that as we potentially go through more of these price spikes.
Okay, so that's what I was just going to ask you. So the spikes themselves, as long as they are spikes and not sustained, really is not indicative necessarily of what fits, say, over a medium term. So what happens when there have been several, or even just one, big price spike in oil, medium term out for the equity markets? What's sort of the historical analysis there?
Yeah, I think the interesting part is, first of all, starting points matter, but I will say that just from a backdrop perspective, it is very different this time. I know those are the four most dangerous words for an investor, but I think you can measure the difference, and the measurable difference is because of U.S. shales. So when you study history, for the bulk of the historical data that I look at going back to 1962 is usually what I talk about. The U.S. was a net importer, oil, goods, and services as a percentage of corporate profits or the overall economy for the consumer was about 9%. We are very far removed from that now. It's 3% of personal income is spent on energy, goods, and services for the U.S. consumer. But more importantly, the U.S. has shifted to net exporter status. And you can really measure it for anybody that's interested in the charts. Go to my LinkedIn feed. You'll see them. Since 2012, back up.
I know what you mean.
What you see is a real strong inflection, obviously, based on oil production in the United States. This is what is dramatically different from anything that we've measured over the last 30 to 40 to 50 years. And that has created a difference in terms of the measurable impact of the incidence of oil price spikes and the duration of oil price spikes. Really? So if you look and say price spike, let's define it, 15% move, that's a top quartile event over any 6-month period. How often did that happen pre-shales? And I'm defining that as 2012. That happens about 12% of the time. How about post-shales? only 6% of the time, half as often, right? So the incidence, the entire incidence has changed. Why? Because you could think of it almost as an abundant reserve or abundant production regime. This is a very different setup from what we've measured historically. So all of a sudden, the impact of oil is almost asymmetrical, meaning that it used to be bad and good, but now the price spikes aren't nearly as bad as they were, meaning that they're not really market drivers, but the good is still good because it can still, that downside in oil prices can still give you a tax cut as a consumer that you can spend somewhere else.
So is it actually a signal then? Like when you see a price spike, if you look at the data, is it actually a good time to buy?
In some ways, so the market, yes, more often than not, because in some ways it correlates to that reversal. So the bigger the price spike, again, that 7% moves happens less than 1% of the time. What do you usually see after that? You usually see a reversal. Where on some level, again, there's certain points in history where it's not always true, but it is more often than not true that you see a reversal, and that reversal drives the market higher, which is almost like that measure of uncertainty. It's very contrarian. So high uncertainty is a good thing. Why would that be? Well, because when it's high, it usually declines. Same thing with oil prices. How could high oil prices be a good thing? Well, because usually when they're high, especially in this abundant reserve regime, they can decline, and that's the driver.
So, okay, if I can just pick up on what you said a couple of minutes ago, you said that there used to be 12%, or we used to have shocks that sort of ran in the realm of 12%. Now they don't say. So we just have less oil shocks, period.
Correct. Less oil shocks, and the ones that we have are less durable and less persistent. So yeah, they're just smaller and they're less often. And it's partly the fact that the market is fairly smart, right? As it relates to, I always get a lot of questions on, well, if supply goes up and supply comes off, and demand is constant, then you're clearing that inventory. So look, maybe you're winnowing down your sort of excess supply or your excess inventory, but at the same time, the market's smart enough to think about that excess capacity that could come on as soon as prices go back up. And that's why, as much as people like to look at inventory or inventory measures, I always say that excess capacity is 10 times more important statistically to oil prices than inventory is. So you can take those barrels off the market. Yes, shale production might slow, but if the market's smart enough to know that, well, if prices go back to where they were, that shale oil is going to come back on, then again, the risk reward for energy is lower from an oil price basis, and it's significantly lower in the stocks that have even their own problems unassociated with what I'm talking about in terms of this excess reserve regime.
Due to tariffs, due to other things that are going on in the economy right now.
Almost just a lack of profitability. I would say it's not really about the economy. Now, oil, it's interesting, really marches to its own drum. And in some ways, fundamentals are the ultimate driver of oil stocks. The problem that energy companies had is that they had it too good in 2022. So you had this very high ROE, you had this very high operating margin, you had this very high free cash flow generation when they cut back CapEx. And when you look back to 1962, you would say that they never had it any better. Now, the problem is that was an abnormal environment. So what you have seen from them is, yeah, they still generate a lot of free cash flow. They're still pretty profitable, and they still have decent earnings growth, but it's still slowing. You're getting back to a re-normalized environment. And this is all happening at the same time where other areas of the economy, like technology, are becoming more profitable when they're re-normalizing to their profitability. And investors should always remember, because I get a lot of questions about self-directed investors on energy, and as Canadians, you know that you're very interested in the energy sector. Always remember that energy is one of the only cyclical sectors where you get trough multiples on trough earnings. So a lot of those economically sensitive sectors like technology is like when earnings dive, you end up paying bigger multiples because the market tends to look through into mid-cycle earnings. So in some ways, you get a cushion to that blow of whatever the economy is. You don't get a cushion in energy historically. It's one of the most the magnitude there is really magnified. So your downside is even more magnified because you don't get the multiple appreciation, you get multiple depreciation. But if you're playing recovery, that's why energy is a great way to play a recovery because it's magnified to the upside as well. So just be conscious of that. is that we're not really renormalized from a fundamental perspective, and you can end up being magnified to the downside because you don't get that cushion impact from multiples.
It's, as you say, starting points matter, and this is not a starting point that's of interest. Is that about right? Okay.
No, that's exactly right. Great way to summarize it. Yeah, we're not there yet. I'll let you know when we're there.
Yeah, let us know when we're there. Exactly. And just sort of more broadly, the reaction of oil as an asset class to geopolitical tensions, but even more specifically than geopolitical, like actual military action, which is exactly what went on last weekend, and has been going on for some time. I mean, is it market moving, and to what extent has that always been the case, or again, is it a bit of it's different this time?
No, that's what's the same this time. I mean, it is really interesting when you study history. You would certainly think that military action has a really strong impact on the market, but you can study even back to World War II, from the start of, I think it was German rearmament in 1937, right before the market fell, to the end of the war in 1945. Equities returned 6%. I mean, you might be able to squint and say, well, that's below average returns of 8, historically speaking, but it was still pretty good returns back then. So it's interesting. And even from the time the war actually broke out, by the time the war actually broke out, after that to the end of the war, stocks were up 50%, which is why there was an old adage long time ago, which is sometimes there's just weird, strange, contrarian impact of military events, where the old adage was, buy the cannon, sell the trumpets. And that worked, like, this is many years ago, as it relates to, I think, the Battle of Waterloo in the fixed income market in the UK. But I think that old adage still rings true from an equity market perspective. You have to be very careful as an investor what very ominous headlines might actually mean for anything other than the short term, right? Could it move it that day? Could it move it that week? Absolutely. But for any long-term investor, and by long-term, I'm really only talking about looking through volatility for a year, it doesn't seem to have a really definitive impact. Could you pick out the isolated instances where it has? Yes. But would you as an investor want to bet your retirement growth or all of that on knowing that it's going to be one of those isolated instances? So you may want to bet on it, but I would say that when you look at history, there's a big cautionary flag in terms of be careful, because more often than not, you might not be right about this.
That is so fascinating to take a look at the actual military action connection to where markets have gone in those periods of time. Oil itself at higher levels, which again have come back down now, but if the oil price stays at higher levels, do we sort of punch that into the stagflation situation? Again, oil gets stripped out of a lot of inflation measures. We know that, but it's still there. So if you have oil at high prices, but other things aren't growing, I mean, does it sort of fit into a stagflationary environment story, or is that actually not the core of what we seem to be talking about sometimes on the stagflationary front?
You can certainly call it that, and you can certainly build a narrative around it. The question is, would you like to build an investment portfolio around it? So that's the interesting part. And again, for anybody who's really interested in the charts, you can check them out on my LinkedIn. So let's just take the fact that if we define stagflation as an economic contraction with accelerating prices, that's been historically bearish for the equity markets if you can predict it. But it's equally bearish when there's an economic contraction and prices are falling, meaning a deflationary bust or stagflation. Now, if you take it one step further and say, okay, well, we know that recessions, whether they be inflationary or deflationary, are potentially negative for equities. What if we just say, well, we've been through this, like discounting recessions that didn't end up happening too many times. Let's take recession off the table and let's just call it above or below average GDP growth and above or below average inflation. So now let's mark everything since 1962 into those 4 quadrants. Right, so above or below average real GDP growth is about 3% as a breakpoint, and it's the same for CPI, right? So CPI, the breakpoint above and below average is about 3%. So if we want to define stagflation that way, from, you have below average GDP growth slowing, below 3%, that's kind of where we are. With inflation above 3%, almost where we are, depending on how you measure inflation. Does this matter for the equity market? And the answer is not really. So you get the same range as any of the other 3 quadrants with almost the same average returns. So again, it puts us into an interesting, dangerous position where I'm telling you something like, oh, this could be a stagflationary event. And you're sort of biased as an equity market investor if you hear that. Well, that sounds bad. I don't want to be in stagflation. But outside recession, it doesn't really mean much to your portfolio. So I think we have to be very specific about how we define the terms, what that means, and if you should use that as a marker to buy or sell equities overall or buy and sell sectors within it. Because more often than not, with the bulk of the data that we have, it really doesn't help you make any investment decisions.
Okay, so what does, and you are the one who educates us on this often, as do other investors, is really the starting points and the valuations themselves. So if within sort of a stagflationary environment, whether we are or not in that right now, that doesn't tilt or lead into really the ideas of where stocks have gotten valued up to this point, up to entering such an environment. Where are we with sort of the valuation story? I mean, we're at all-time highs basically on the U.S. equity markets. This is where we sit, and it's almost a watch moment to see where this is all going. Can that continue? Does stagflationary sort of is like a wet blanket on top of it?
Right. No, it's a good question. I actually just had that question from a Washington Post reporter yesterday. Like, does it make any sense that the market's hitting all-time highs here? I mean, we're a whisper away from it. But interestingly enough, both the NASDAQ and information technology sector are already at all-time highs. And I think that that's around the fact that this is sustained leadership. And what we saw in that, bear market that was quite adjacent to a bear market, we saw a really phenomenal amazing reset in technology valuations across the board. So it wasn't just the overall technology sector that at that low was down to median levels, a level that we haven't seen anytime over the last 5 years, but it was also the risk assets within technology. And that's the interesting part. I mean, I talk about sectors a lot. I don't always talk about factors, but factors are really interesting when they get to extremes, because not only do we see tech as a sector actually, have a strong valuation compression, but we saw within that sector, equity investors de-risk massively. Again, so risk within technology sector has now de-risked to levels we have not seen over the last 5 years. And that is basically equated to semiconductors from an industry perspective. It was all true. Now, look, I mean, you're sort of piecing together like NVIDIA and everybody else. But what you see is if you put it to a cohesive basket of semiconductor stocks together, we weren't in really strong valuation territory until now. And the interesting part about this is it shifts the risk reward for me. When you look historically, you get really strong odds once you're at the starting point in valuation, whether or not fundamentals decline or improve. We haven't seen that math for a very long time, or at least, very long for me is like 3 years. That seems like a lifetime from an equity investor perspective who does this research every day, right? So, I mean, the interesting part about all this is not only did, you don't necessarily have to bet on fundamentals declining, but this snapback that we're talking about, back to all-time highs, technology sector already at all-time highs, you would think that, well, didn't they snap back to expensive territory again? No, in fact, they did not, because relative earnings growth versus the rest of the market has continued to accelerate. And I think this is a key buy flag that I like to look at in my work, where you're outperforming and getting cheaper from a sector perspective or from an industry perspective. That's like a bell ring to say, hey, look at this. This is a really good setup where you can have strong performance and still get a more likely viable valuation tailwind even ahead. And I think that's the situation we're in.
I wanted to ask you about the data that came out today. I was actually looking at the revised GDP numbers in the US, and just kind of wondering if we're reaching that point of where, okay, the data is starting to come in. There's a lot of uncertainty, a lot of pull forwards, not sure, but we are in Q2 now. Well, we're on the cusp of the third quarter. This is sort of where it was going to bite, we thought. Is that what we're seeing in some revised data? Is that what you see?
I think we're probably not there yet in terms of seeing signal. I mean, you did have extreme pull forward in demand. So it's kind of looking now like, is growth falling off a cliff? Is that's what's happening? And we're going to have to wait and see from that renormalizing perspective. A lot of the numbers that I looked at from GDP, just even the quarterly consumption growth, you're not really seeing a market downshift in the year-on-year rate. I know that there's always the quarterly moves and people, annualize them. And between the seasonal adjustments and annualizing one quarter, I think that you can get a lot of noise. When you look at it more on a year-on-year basis, you're not really seeing anything yet. In fact, the biggest decline in the GDP numbers that I saw was actually in healthcare services.
Hmm.
So not clear that that would be really a market mover behind the uncertainty levels that we saw. What more interested me in terms of the 8:30 data that came out this morning was that advanced durable goods number.
Okay.
And that's one of the series that I really look at. You know, you hear me quote a bunch of other series that I really monitor, like the NFIB survey,
Right.
the Philly Fed expectations survey. Advanced durable goods are really interesting to me. The core number, which is X aircraft, you can look at, and much like ISM in manufacturing and much like the small business surveys in terms of credit, have been in this, quagmire of, let's call it, a quasi recession for really the last year-ish, right? Nobody would say that the manufacturing economy is growing gangbusters, right? So
Right.
this starting point matters. And that's why it's interesting when you look at those high levels of uncertainty. I had so many portfolio managers ask me, well, given these high levels of uncertainty, corporate America isn't going to spend, right? And that's going to be a problem for stocks. And when you look at high levels of uncertainty historically, it is actually the exact opposite. That's usually coincident over the next 12 months of an acceleration in durable goods orders or capital expenditures or investment spending, however you want to measure it. And you go, wait a minute, Denise, that doesn't make sense. Why would that be? Because at the point at which there's uncertainty, you've usually already slowed your spending and haven't spent. And that's exactly what is happening now when you look at the economic data. Despite the fact that we're not in recession, you're not seeing a lot of hiring. You're not seeing a lot of durable goods orders over the last year. You're certainly not seeing a lot of GDP or strong GDP growth over the last year either. So that is the defining setup as it relates to the acceleration. So what we saw in the 8:30 data is, again, despite this uncertainty, advanced durable goods still accelerating.
So the pantry's empty. They got to fill it up, and the abundance discussion that you had earlier sort of takes over. It has to be done, and they've held off
That's
for
right.
some time, and so a new cycle begins. That is fascinating. The other thing I wanted to ask you about was the labor market, and taking a look at sort of what some commentators are calling it sort of a slow, steady, continual claims story that they're watching. To what extent is the Fed watching? I mean, they're always watching. Is there anything there that leads you into this could move the Fed to cut for the wrong reasons, essentially?
Yeah, the wrong reasons are the unemployment rate going up and going up rapidly. I don't think we're there yet. We are still in this sort of, slow slogging growth where I think that the best you can say is that it's sluggish, right? It's not terrible. There's no contraction in employment. And you'd certainly say when you look at even layoffs that aren't really definitive, you'd say that there's not too many layoffs, there's not too many firings, but there's also not a lot of hiring still. So it's almost like a labor market that is just not dynamic at all. Now, the labor market is, and certainly as it relates to the equity market, but generally speaking, a lagging indicator. So if you say, well, what ultimately drives hiring? Ultimately, it's corporate profits. The stronger that corporate profits are, the more likely you are to see an inflection in people hiring. So to the extent that we want to back up and take the long-term view, if we're in this sluggish environment, what are the odds that we get out of this sluggish environment to the upside? Or does it continue, to your point, to denigrate to the downside and call the Fed for these cuts? I think you got to look statistically to corporate profits. And corporate profits might be in this situation where, once again, we priced in a recession that may not end up happening based on a lot of the soft data that we're seeing, meaning that, expectations came down from 10% growth to 7% growth. But now that we have this situation of, we got a big tax cut coming for corporate America that could be a 7% tax cut, that's meaningful. Oil is a lot lower. That's got a really contrarian impact on corporate profits. All of these things say corporate profits might be better than you expect over the next year. So maybe you should think from a risk reward perspective, the labor market ultimately will follow.
I try not to ask you international questions because you focus so deeply and so beautifully on what you focus, but I'm curious whether the corporate tax discussion in the United States will instigate other countries, I'm thinking of Canada obviously, but others, to lower corporate tax rates, because it does seem like there's going to be a dearth of growth in certain areas for companies and countries around the world. Does that sort of thing happen where it sparks it in other parts of the world?
I mean, to the extent that they study history, I think that there's been some pretty good data around the original tax cut in 2016, specifically for corporate America. We can debate personal taxes, which is not as nearly as predictive. But the permanence of corporate tax rates, first of all, as being a permanent tax cut, and especially the repatriation that was done at that time, does create a better scenario for corporate profitability. And the higher corporate profit margins are, the less likely they are to lay off. Look, there are a lot of reasons why corporate America didn't pursue layoffs, certainly in the pandemic, but even in 2022, it was a fairly steady hand, even in a downturn when the Fed was actually raising rates. I think part of the reason for that, and again, this is more supposition than historical fact, so it's a corollary, not a potential causal reaction, but was around the fact that corporate tax rates remained low. And I do think that that has sort of a relationship to the level of hiring that you're likely to see in economy. So to the extent that other countries study that impact, I think that there is a fair chance that they pursue the same options.
Yeah, it's really interesting. It just seems like because they get to the point where you just sort of they add and add and add, and of course then it becomes too far. So here's a question for you, Denise. Do you expect the U.S. currency to perform, or how do you expect it to conform compared to international currencies, keeping the recent geopolitical events and U.S. debt in mind? Yeah, the dollar. I mean, it's been off today, so.
Yeah, great question. And I just got asked that exact same question by portfolio manager Jed Weiss, who runs our international funds. Yeah, and I have to say, look, I don't have a strong view on the dollar because I feel like, for the most part, when I look at the data, there's not anything meaningful problematic. So when I look at the long-term drivers of currency, it tends to be relative growth, meaning how fast do you grow earnings versus your counterparts, or how fast does your GDP grow versus everybody else, and relative interest rates, like where am I getting the best yields as an investor? Those two, in my estimation, and people can disagree, I think still reside very clearly bullishly in favor of the dollar. From a debt perspective, it's not very clear to me that absolute levels of debt are particularly meaningful. It's the relative level of debt that tends to be more market moving. And that's when you see, like, long in history where emerging market crises evolve, where it's a relative game. So if you don't want to buy the dollar, are you more comfortable in the euro? Are you more comfortable in the yen from a debt perspective? Are you more comfortable in the RMB? That tends to be the calculus. And as bearish as we want to get on sort of the talk or the narrative around US debt dynamics, A, it's not clear that it's better anywhere else. And B, in the data that we look at from the tick data we get on a weekly basis, nobody's selling US treasuries. In fact, they're hitting all-time highs in terms of foreign. So some foreigners are selling, but more foreigners are buying than selling our US treasuries. So none of this is clear in the data that it tends to be bearish for the US dollar. Now you say, well, Denise, then why aren't you a dollar bull? Well, there's two reasons why I think that there is some potential for downside. One is that, again, starting points matter, the level of valuation. Real effective exchange rates are in top quartile range, some of the highest they've ever been. So you have to be open-minded that, a dollar devaluation might just happen because of that overvaluation. So that's possible as well. The other possibility is we have an administration that potentially wants a weaker dollar. That's also possible as well. Now, it's not clear to me from the data that whatever administrations want, they get. We don't have to go very far back in history to say that that is not usually what happens. So again, back to those core drivers. But I do think it's more balanced and a more nuanced conversation rather than just debt or even growth as it relates to the dollar. So I'm not really bearish on the dollar, but I'm not particularly bullish either. Wouldn't be surprising to me if we had this conversation in a year and it was at the same levels.
That's really interesting. So it might just kind of bounce along here within a range. Just before we let you go, you mentioned sustained leadership for tech. Just give us your top three sectors, bottom three sectors.
Yeah, top three sectors: technology, financials, and consumer discretionary. Bottom three sectors: consumer staples, healthcare, and energy.
Okay, that answers the question that we have on healthcare. It's wonderful to see you. Thank you so much. Happy 4th of July when you celebrate next week. Always great to see you, Denise.
Great to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.